Hello everyone, my name is Steve Seger and I am the Director of Acquisitions and Investor Relations here at SNS Capital, joined today by Jered Sturm, Co-Founder of SNS. Thanks for joining me, Jered.
Yeah, I'm excited to jump into deal structure, and thanks for putting the conversation together. I think it'll be helpful to potential investors and even some of our current investors.
Yeah, so as he mentioned, today's video is going to be just an overview of how SNS is typically structuring our deals. We're going to dive into a couple of different topics, including a sample of what our deal structure is versus what another hypothetical one could be. But Jered, just to kick things off, I want to highlight alignment of interest and want to ask you, when you were structuring how SNS was going to set up their deals, what did you have in mind and what was behind your thought process when you were going through that?
Yeah, so the first 8 years of our career, we did not raise money from investors. And then when we were making the decision to go into the syndication model, we were thinking about this idea of alignment of interest, because while one side is passive and one side is active, ultimately it's a partnership, and we want that partnership for everyone to have that alignment of interest. And I'll give you an example, Steve. It's like there's syndications, and no right or wrong here, but like there are syndications that charge disposition fees and construction management fees, and those are very valid fees because that's a lot of work to position a property for the sale, being disposition, or the construction can be a huge project and it takes a lot of energy. So it's justified, but it also does open up the question of, is it the right time to sell the property because it's the right time to sell, or is it the right time to sell because the GP earns a 1 to 2, maybe 3% fee, disposition fee on $10, $20, $30 million deal, and how could that potentially skew their judgment and disalign the interest between the LP and the GP, or construction management fees, right? You could argue that it would potentially encourage the GP to over-improve the property. One of SNS's strengths is like understanding the return on investment through our construction efforts, not over-improving, but improving on things that will actually generate a good return on investment. So those are just two fees that illustrate that we did not involve into our structure, and we boiled it down to just the things that we felt were just clear-cut, true alignment of interest. I'd be happy to dig into that.
Yeah, and what I'm going to do is I created a graphic here that I'll throw up on the screen so you guys, as the potential LP, can see exactly what we're looking at and give you a good display here. So yeah, go ahead and dive into how we structure these.
Yeah, so in the second box here on the left side, I guess, the way we make money, SNS, is through acquisition fees, asset management fees, and a split of equity. And so that acquisition fee for us is at the industry standard low, which is 1% of the purchase price. The asset management fee is going to be 1% of effective gross income. That just helps us keep the lights on while we're forcing appreciation into these assets and satisfying the preferred return to the LP investors. And then our split is a 70-30 split of equity, with a 8% preferred return in front of it.
And you mentioned the preferred return. I want to highlight that we have an example here to illustrate how exactly that works. Before we dive into that, I want to hit on a few more things on this graphic here, and we'll keep on moving. I've heard a lot of operators talk about waterfalls. How exactly is SNS using a waterfall here, or are we even using a waterfall?
Yeah, I think there's different ways to define that, but I would say we are not. And so there's some syndication sponsors who will, once you hit a certain performance hurdle, like an IRR of, let's say, 15, the split may go from 70-30 to 50-50, and sometimes there's multiple waterfalls, right? Once you hit a 15 IRR, it's this. Once you hit a 20 IRR, it changes to something else. It can make the math pretty complex pretty quickly on how to calculate what will you actually get as an LP. So again, on that kind of simplicity and alignment of interest, we said no waterfalls. It's just 70-30 split with an 8 pref. Regardless of how big the upside is, we'll share in that upside to the original agreed upon equity split.
And why would someone, I mean, aside maybe from simplicity, like the fact that there's no waterfalls?
Yeah, I think it does encourage the GP to perform at a higher level, but at the same time, it's like, if this thing that we took equal risk in, the investor took the risk, the LP took the risk, and it's kind of like, if the reward is bigger than we anticipated, we're going to dilute that. And it's kind of like you took the risk, and so I think you should receive the reward regardless of where it lands in the spectrum equally. So we've been fortunate, of course, with great market conditions over the prior, say, 15 years and a lot of hard work. We've had the wind at our back to outperform our pro formas very often, but that just means the investors do really well. So they benefit from that, those market conditions, just like we do, but at an equal proportion no matter how high it goes.
Got it. All right, I'm going to move on to these last two boxes we have here. Can you explain to me the difference between return on capital and return of capital? This was something that took me a little bit of time to get it to click, and I think you'll have a helpful explanation here.
I think it's important to say that it can be, that definition can be different under different syndication structures. So for us and how we structure the deal, a return of capital is when we have a refinance or a sale. Okay. So proceeds or distributions generated from a refinance or sale will be a return of capital. What that means is, Steve, if you're an LP investor and you invest $100,000 into our deal, if we only ever gave you $100,000 back, you wouldn't be very happy with that, right? Like, I gave you 100, you gave me 100 back, I could have just kept it, right? But return of capital is the money that you invested just coming back to you. A return on capital is what that money actually generates and earns through operational cash flow. And so it does take new investors some time to kind of like split that in their mind of like, what does that mean? Because for us, a return of capital will reduce the basis in the deal, meaning how much money does an LP investor, or potentially a basis could be defined as like how much money does all LP investors have in the deal. And so return of capital will adjust that basis, but return on capital will not adjust the basis, which is how our preferred return is calculated.
How does returning that capital impact the split, the 70-30 split that we use?
It does not, right?
Does not.
Yeah.
Okay.
So if we were to return in that hypothetical example, if you invested $100,000 and we were able to do a successful refinance and give you your full $100,000 back, your ownership percentage would stay the same. And so depending on how much equity was raised at the onset, like let's say if you own 5% of the deal total, you would still own 5% of the deal even if all of your capital was returned back to you.
Got it. The last box here is, what is the typical time frame for our deals, and why is that time frame what we chose?
Yeah, so 10 years is our typical time frame for a deal, but it's going to be outlined in the OM prior to raising capital. So it might be 5 years, it might be 7 years, it might be 10 years, but for us historically we've gravitated towards 10. We like long-term fixed rate debt, so we put that on it, and then we lean on our competitive advantage of operations. So what we have determined through having that competitive advantage is the best way to make money is to own real estate, not to sell it. And so we force appreciation, we capture that appreciation through refinances rather than sales. But while raising money from passive investors, we have learned that most people prefer to have an end date on it. About the farthest out we can go is 10 years, and so that's the target we've gravitated towards.
And what led you to have that conclusion about real estate? Why would you prefer to hold it longer term than sell?
Like once you get familiar with an asset, and if your competitive advantage like ours is operations, you learn small nuances about how to operate this property to maximize the cash flow. And if you're just always trading out to something new, yes, you're capturing your upside and you get good churn, but you're not carrying with you all the efficiencies of how you've learned to polish that asset and produce the best possible cash flow. So you can strip the equity that you forced into the deal through restructuring your debt, while also remaining or keeping those the advantages that you've learned about that asset.
Yeah. I think too, one thing that I'll comment is, at the end of the day, we're out there looking for the exact kind of deals that we already own. So why would you sell something that you're looking for? But great, we hit on these 6 spots here aside from preferred return. And this example here, we're going to jump in. I'm going to let you kind of take the reins here and show us what we're working with.
Yeah, and I think, Steve, what would help me is if you kind of take the position of maybe a newer LP investor that's considering syndication and considering SNS. And so at any point, feel free to ask questions, and it will only help the people who are watching this video. So I'll dig in, and we started this video talking about alignment of interest, and you asked me to put this together for an outline of preferred return. And I think what I tried to do here was highlight why a preferred return creates alignment of interest. And so what I did here was I gave 2 structures. One is a 70-30 split with an 8 pref, which is what SNS does. and then a 85-15 with no pref. So just two different structures, and again, no right or wrong, and there's a million different ways that syndication sponsors split this, but we're highlighting why does a preferred return create an alignment of interest between what the GP is doing and what the LP is receiving. So quickly going through our rows here, obviously we just have year, so broken out by year, so year of ownership of the property, cash on cash return, basis, that means all of the investor capital that is in the deal, so how much LP capital did we raise, cash flow, LP pref, meaning like the limited partners, how much preferred return did they receive in that specific year, LP upside is anything over the pref, and then LP total would be the combination of the upside and the pref, totaled up for total cash flow for the year for LPs, and then GP total would just be the cash flow for the general partner for that specific year. And then accrued pref is if the performance of the property and the general partner are not able to satisfy the full preferred return, it would accrue and be owed to those investors in the next year and need to be caught up. So any questions on that, or you want me to jump right in?
So the accrued pref, which column does that get added onto here?
So if
In year two?
Yeah, in year two, it would show up in this column here. So LP pref, meaning like if we fall short of what we have, of that preferential treatment or that preferred return to the LPs, if we fall short of the 8% that we have outlined in our structure, then we need to make sure that that gets paid prior to the general partner making any money. Did I answer your question?
It did, yeah. And my second one would be, are the totals that we see here, like for example, the cash on cash return in the top, are those pretty typical?
So for SNS, focused on C to B class multifamily in Cincinnati, Ohio, being a Midwest market, yes, we're able to find even value add deals that are producing these types of cash flow numbers in year one, despite sometimes having some form of distress, just because it's a strong cash flow market. It's a strong cash flow asset class, being C to B class multifamily. So yes, like that would be a achievable return in year one for something that we would buy. And then that jump from 6 to 11 from years 1 to 2 would be pretty typical for the type of pace of acceleration that we might have in a value add deal.
Got it. I'm good. You can
Again,
jump in
leaning
here.
back on those operations to ramp that up.
Yeah.
Okay, so just going through, again, two structures, same deal, like so same property, same cash flow, same amount of equity raised, but two different structures, and how does that trickle down into what the LP makes, what the GP makes, and how does that alignment of interest all shake out? So quickly going through, year one produces a 6% cash on cash return. We raised a total of $1 million in the deal to buy this asset, but 6% on $1 million is $60,000. The pref, the preferred return that we're supposed to pay investors is 8% of $1 million, so it should be 80, but there's only 60 to pay. So we pay the full 60, we give all of that to the pref. There is nothing left over, so there is no upside. But so the LP total is $60,000, that's what they make for the year across all LPs, which leaves nothing for the GP. And as I said before, the preferred return, we should pay $80,000 per year. We weren't able to achieve it because the property did not produce enough cash flow, which accrues $20,000 that needs to be paid before the GP can make any money. So that then rolls forward to year two, where we have started to perform much better. We produce 11% cash on cash return in year two because the property's starting to stabilize. We're forcing that appreciation. We're able to figure out how to cut expenses. But the basis is still the same. We've raised $1 million from LP investors, $1 million still in the deal, but 11% on that $1 million is going to be $110,000. So the LP pref paid in year two is going to be the 8% on the $1 million, which is $80,000, plus the accrued that rolled forward. So again, we got to pay this before the GP can ever make any money. So that gets covered because we did well and got an 11% return, which leaves the difference between these two, $10,000 of upside. Anything above the pref is what we would call upside. So 70% of that upside goes to the LP. Again, 70-30 split. 30% goes to the GP, $3,000. So the LP for the year makes $107. GP for the year makes $3,000. There is no accrued preferred return because we were able to satisfy all of the preferred return here. So nothing rolls forward. We roll into year 2. It's kind of like where we hope to stabilize at 12% cash on cash returns. It produces the cash flow of 120. We satisfy the pref of 80. That leaves an upside of $40,000, which gets split 70% to the LP and 30% to the GP, leaving the LP to make 108 and the GP to make $12,000. No accrued preferred return. So any questions on that before I kind of translate that onto the other structure?
I'm following. I don't have any questions.
All right. So then again, same money into the deal, same equity raised, same returns, just a different structure. So there's under these rows, there's never going to be any pref because there is no pref under this structure. So it's all just split. So property makes $60,000 in year 1. Total LP is 51K, and the GP is 9K. So I'll give you, I don't think I said this on here, but let's say hypothetically that in year 1, the return is 6%, but in the pro forma and the OM that the sponsor puts out, they promised, or not promised, I shouldn't say that, they projected 8% returns. And so they projected 8, but they, for whatever reason, they were only ever able to hit 6. In this example, despite underperforming their projections, the GP still makes money. In this structure, underperforming their projections, they make no money. And I think that's a better illustration of alignment of interest. We'll get rid of that. And so moving forward, you got into year 2, same return, 110K, same cash flow all the way across both of these structures. No pref because there is none. That leaves you with the 110K to split based on 85 to the LP, 15 to the GP. So 85% equates to 93,500, and the GP makes 16,500. And then, as you can imagine, we just go into the same structure here with the LP making 102 and the GP making $18,000. So at the end of the day, the LP total under this structure. So what does the limited partners? All the limited partners make under the 70-30, and what do the limited partners make under this 85-15 with no pref? And so this number, sorry, I'm trying to not get in front of you. So the LPs make $275,000 in the first 3 years of this investment. And under this structure, they make $246,500. So that's the total of that. And so they make more money under this structure, and there's that better alignment of interest where if they underperform, they don't make anything in years like this. And so that's one example, and just totaling this here, GP made $15,000 under this 70-30 split, and the GP made $43,500 under this. So made a significant amount more money. And under these two different structures that we're contrasting here, there is a tipping point when the upside is so significant and these cash on cash returns become so significant that it would be more favorable to have a bigger portion of the deal. But these are, you're talking 20-30% returns to see that tipping point. 20 to
30%?
Yeah, that's where you'll start to see kind of it switch to where it's like this is more favorable to the LP.
Okay.
But I think like realistically, the deals that we're seeing in the market are more in line with like these types of returns. And so I think the pref gives that assurance and that structure where there's that alignment of interest to say like, yes, you'll get more of the potential upside, being the GP would get more of the potential upside if they get a ton, but it also protects the LP from the downside of something like this. Like the GP made money despite underperforming.
Yeah, I mean we're incentivized to perform.
Right.
Yeah.
Right. And so as Steve, as you know, like the SNS's core strategy is value add investments. Buy a deal, maybe it's a 10-year hold, but around year 3, maybe 4. We're going to go in and do a debt restructuring, supplemental loan refinance after we force that appreciation. And I actually think I'm going to roll this in front here.
Yep.
But the one thing I really want to point out is it disaligns the incentive under this 85-15 split to do a refinance and return capital back to investors. So we talk about return of capital, giving the investors capital back. So when they invested that $1 million into the deal that you have on basis, how quickly can we get that money back to them is often highly important, because then those investors can go out and reinvest it into something else.
Right.
And so let's say on this hypothetical that we're talking about, we're comparing these two structures. At the end of year 3, we were able to do a refinance. We forced a bunch of appreciation into the asset. We did a refinance. The loan proceeds from that refinance allowed us to return $1 million back to the investors, which was a return of capital of $1 million and took their basis to 0.
Right, and you said that the basis is the equity raised for the deal from the investors, right?
Correct,
Okay.
yes. So how much money do LPs have in the deal? So you could say, what is your basis, Steve? And you might answer that hypothetically like $100,000. That's your basis as an LP investor. But when we're writing it over here as $1 million in this hypothetical deal, we're saying total LP investors basis in this project is $1 million.
Okay.
But at the end of year 3, we did a refinance. The loan proceeds allowed us to do a return of capital of $1 million, which took our basis to 0. So as we roll through year 4, everybody has their money out of the deal for both structures, which results in the cash flow. I know I'm blocking the prior dry erase board, but the cash flow would decrease because we took on more debt, which would mean we have to service that debt, which would likely drive the cash flow down. So we see a decrease in total cash flow from year 3 to year 4, and that's because of the nature of taking on more debt and having to satisfy that debt. So $80,000 basically is both deals. The LP pref is 0 for both. This 85-15, they never had a pref, so they never paid a pref, and that's the way it's going to stay. This no longer has a pref because, again, the preferred return is calculated off the basis. So 8% of the money you have in the deal. There is no money in the deal because we returned it all.
Yep.
So 0 there, which results in just a straight split. So 70-30 split of the cash flow would be LP $56,000 for the 70-30 split and $68,000 for the 85-15 split. What I really want to point out here, though, is like the remainder, what's left over, $24,000 for GP total distributable cash flow in year 4. And for this 85-15 split, the total distributable cash flow, it's kind of right there, is $12,000. And so I'm blocking it, but as I look back to this 85-15 split in year 3, it was, in year 3, $18,000. And so the alignment of interest that we're trying to illustrate here is, why would this GP, who has full control over this investment, choose to restructure the debt, do a refinance, and give you your $100,000 back, or all investors that are $1 million back, if it's going to make them make less money? But you as an investor want your capital back, so that way you have de-risked the deal and you can go out and invest into something else, right? And earn additional returns on that capital while this continues to produce. And so I think that comparing these two structures, specifically for value-add deals, having that pref encourages sponsors like us to get rid of the basis, and the way we do that is by giving you your money back as fast as possible. And so I think that just further illustrates, hopefully really digs into like, what is a pref, why is a pref, how does the return of capital better align? And I think when contrasting these two structures, and it really just illustrates why that's better for an LP.
Yeah. Well, you answered all the questions I had. I'd like to wrap up here pretty briefly. But I wanted to thank everyone for sitting here. This is really just, again, a resource. We're trying to create content like this to be educational and just try to teach. And we do appreciate you for sticking around this long. And Jered, I want to thank you for taking so much time to help us today. Appreciate it.
Yes, thank you.